Welcome everybody to the next video of this FX program. Now we're going to get straight into it. This video is all about higher time frame and lower time frame entries, and you can actually understand both options. They're completely different trades. Higher time frame trades we're going to get into, they're a lot bigger. There's not as many steps, I guess you could say, if you're scalping on the lower time frames. And lower time frames, it's very fast paced. Everything's a lot smaller, shorter, and you've really got to monitor your positions over the long term. But I think as you obviously progress throughout this program, you'll start to learn each of these different trading styles. High time frame entries and lower time frame entries are two different trading styles. And if you like longer term positions, you don't like to be sitting at the chart looking at the screen for 4 hours at a time, higher time frame entries might be for you. And higher time frame entries are pretty good for beginners, I will say. It's, I think, yeah, a simpler analysis. But anyway, we're going to get stuck into that. But what I will mention, after we finish with these program slides, you'll see a video of the charts where I actually go in depth and show you these higher time frame and lower time frame entries. My voice may sound a little bit different, and that's because it was all pre-recorded from actually like 2 years ago, 2024. So it's pretty old footage, so stay with me, but I'm going to use it because it's a good example, and it's also a chart example from a completely different economic cycle, 2 years ago, different market conditions, and you're going to be able to see that. And I think the way that I explained it was quite good at the same time. Obviously, I wasn't as good at recording back then as I am now. I'm still shit, but yeah, bear with me. Watch the video to the end. If you don't, obviously, you're not going to really learn anything. But without further ado, let's get straight into it. So what is a higher time frame entry? Now, a higher time frame entry is a trade taken on any time frame from the 15-minute upwards. And I guess it really depends. Like, uh, it, it's really an opinion, I guess. 15-minute upwards is technically a higher time frame, and I only say that because if you're executing on the 15-minute time frame, the trade is still going to take you probably hours for that trade to play out, whether it hits your stop loss or take profit. So that's the only sort of reason why I say it's a higher time frame entry, because it takes longer. Whereas if you're executing on the 5-minute down to the 1 minute, then your positions are going to be a lot shorter. So for example, the 1 hour, the 4 hour, the daily, or the weekly, those are all high time frame entries, and it's perfect trading methods to use as a beginner, like I said, or for someone that is wanting to trade in a more passive capacity, which, yeah, exactly what I was saying before. If you're busy with work, you're just trying to trade in the afternoons, especially if you like to trade fundamentals, higher time frames are always going to win, because yeah, that macro analysis, that bias is going to play out over a longer period than a couple of minutes. So the lower time frames is really, for me, if I'm ever scalping on the lower time frames now, it's to take advantage of short-term price movements. Like I posted into the Discord yesterday afternoon, some of the targets that I was looking at for various pairs like GBP USD, Euro USD, AUD USD, etc. And obviously we want to be buying at the higher lows until we reach that final target. But price, after creating a higher high, is going to pull back and create a higher low. The short-term entries, sometimes you can find a really good short position taking advantage of that pullback to then obviously long-term take the buy position. But yeah, we sort of covered that in the last lesson as well, the difference between those aggressive entries and lower time frame and higher time frame entries as well. But the pros to higher time frame entries is simpler analysis, swing strategy, and it's perfect for beginners. Cons, typically lower risk to reward trades, like the trades aren't going to be as high, but don't fixate yourself on that, because really at the end of the day, it depends on your trading style and how you like to trade. But lower risk to reward, it doesn't, that's not set in stone. And as well, it's probably going to be a lot safer to trade on the higher time frames than it is to trade on the lower time frames, especially if you're not competent enough yet to trade on the lower time frames. I think it's always good as a beginner to start trading on the higher time frames and then work your way down. And then you'll start to understand, oh, I can get a little scalp in here. Because of that repetition, you've started to really knuckle into your brain and soak into your brain how you can take advantage of those short-term price movements, because you've seen that market behavior over and over and over and over again when you're doing your analysis. Trade targets range from a few hours to days or even months. So that's, I guess, could be a pro or a con, but that pretty much sums it up. So let's move on to lower time frame entries. And my head is still in the way, and I'm not really in the webcam. Look, so lower time frame entries, again, pretty much polar opposite to higher time frame. So it's an entry position that's taken from the essentially underneath the 15-minute time frame. That's very short-term scalping, 5 minute, 1 minute, 2 minute, whatever. But by scalping the markets, traders can execute very short-term price movements quickly and efficiently by capitalizing on micro fluctuations, and leverage as well. So again, that's what we spoke about previously. You can really take advantage of those short-term price movements once you have that understanding. Pros, it's fast-paced, usually high risk to reward, perfect for traders that are looking for the next step. So once you've got that understanding and you are starting to become more competent, lower time frame entries can be good. Cons, it is very complex. It's more risk, requires your full attention during your position. So people in the trading industry like to say set and forget. If you're scalping, there is no set and forget. You are monitoring that position the whole time. And if you're not, then you're trading wrong. If I'm just going to be completely honest with you, you're trading wrong. You need to be monitoring it the entire time to manage your risk efficiently and effectively. And if you're not monitoring it, then you're going to lose far more over time, because you are taking advantage of those short-term price movements. You can't use a macro bias and scalp lower time frames. It's just there's too much going on to be able to really, I guess, take as much risk off the table, if that makes sense. So lower time frames, higher risk, potentially higher reward, but higher time frames, it's not as complex. You don't have to do, when we get into the multi-time frame analysis, which I believe is the next video, you'll start to see there's far less time frames that you have to scale down to be able to do your analysis. And it's high time frame entries, really good for your macro fundamental analysis as well, which I already posted in the Discord. So I hope that makes sense, guys. That is it for this presentation section. What we're going to do now is jump straight over to the charts, which you'll see I sound a lot more robotic, so please bear with me, but it is a good lesson nonetheless. So I hope you all enjoyed, and as always, ask any questions in the Discord if you have any, because that's the community, that's the area, the resource for you guys to be asking your questions. But yeah, let's get straight into it. Jumping into the first example of a high time frame entry, we are trading on the NZ US dollar, the New Zealand US dollar. This trade was taken on the 15-minute time frame during the London session. So I'm going to start off with my analysis from the weekly time frame. So on the weekly time frame, obviously we are in this bearish immediate viewpoint. So when you're marking out your viewpoints, you can see here a lot of people would probably mark
from this low to this high as the bullish immediate viewpoint, because as you can see here, from this high to this low, that's the last high and the last low that's relevant to price. Everything else in between that is just noise, right? But that's where people get confused, because from this high over here to this low was the last bearish immediate viewpoint. Price then broke structure, but price didn't break structure here. You can see that there. Price broke structure here. There was a minor pullback, a move to the upside, a bullish run, and then it broke structure. So that bullish move there was the move that actually broke structure. So that would have been the small bullish immediate viewpoint, and then you can see that there was a change of character, what most retail traders would say, or a break of structure to the downside, a reversal where it has broken structure there and it's changed to a bearish immediate viewpoint. So in that range there, and then again price was stepping down, broke structure, price broke structure again to the upside, all messy price action, heaps of liquidity there. You can see the triple, quadruple tops there, these large wicks, a lot of sell orders at the top there, which is a good sign for liquidity, and over here as well if price was to come into this weekly recovery zone. But moving back onto the viewpoints, you can see this move here was actually the last bearish move that broke structure, following the overall momentum, as we can see here on the left, that price is bearish. So and as you can see over to the right where price action is now, it actually hasn't broken the high, which is over here, and the low down here. So we are currently in this bearish immediate viewpoint. Now moving on to the daily time frame, I had marked from this low to this high. You can see this beautiful break of structure to the downside here. Again, this is on the New Zealand dollar cross with the US dollar. So price action is going to look a little bit different on each currency pair, mainly because of the amount of volume that's in that currency pair, and obviously there's different catalysts that move price and fundamentals in the background. So moving on to the 4-hour time frame, I had marked out this above recovery zone, above all of this liquidity here. If we quickly go back to the daily time frame, because I forgot to show you that price looked pretty disgusting in there. Obviously you can see that there's quite a bit of liquidity in there. Price is really tight, it's in consolidation, and during that period, dropping back down to the 4-hour time frame, you can see it more clearer now that you've got all of this liquidity here, liquidity to the downside, and then we had this move that showed an actual direction in price. So at the time of the entry, price was in this bearish 4-hour immediate viewpoint. Don't look over here, guys, just yet. That's after I took the trade. So this, at the time I was doing my analysis, this was the bearish immediate viewpoint that we're in. You can see this high didn't surpass this high, and this low didn't surpass this low. So you've got a lot of people would mark it from this high to this low, which is wrong, because that's just internal structure within the most relevant key levels. So moving down to the 1-hour time frame. I just moved that. Let me just quickly move it back. The 1-hour viewpoint that I had was from this low, where all this consolidation is, to this high. You can see this beautiful break of structure here, because we were in this bearish immediate viewpoint. Then price had that bullish run to the upside and broke structure. Now moving down onto the 15-minute time frame, this is where it starts to get a bit more interesting. Obviously you can see my trade there. Yeah, it did work out. It was a successful trade, which is good. But on the 15-minute time frame, you can see price was stepping down. We had all of this liquidity. Price didn't quite fulfill this 15-minute recovery zone here. And you can see all this trend line liquidity here, which is also a good sign for taking buys as the 1 hour is bullish. Now, price did eventually reverse to the downside and fulfill this 15-minute recovery zone, which is where I got into my position. So we were trading within this 1 hour bullish immediate viewpoint, which was the consensus of the overall market direction for the moment. The intraday bias, I know the high time frames were bearish, but on the lower time frames, as you start to step it down, prices are retracing within those overall time frames. So I took a buy off this position during the London session, and as you can see, I was actually targeting the 4 hour recovery zone that was all the way up here. I'll just quickly go back to the 4 hour time frame and show you which was above all of this liquidity. And this is where you can start to piece it all together, piece the puzzle together, add your confluences together. It's not all just about market structure and candlesticks and those sort of confluences. You need to start piecing it all together. Now, you could have targeted the key level here, or even this key level, or a range of other key levels, which was perfectly fine. Even the 1 hour structural high, that would have been a perfect trade. There's nothing wrong with that. I chose to target this 4 hour recovery zone because of the amount of liquidity that was sitting there. That is a lot of orders, and remember, we are on the higher time frames, so targeting those areas is going to be a lot more liquidity sitting there, obviously, because it's on the 4 hour time frames. It's showing more volume than the lower time frame. So moving back down to the 15-minute, we got into that trade. It was a beautiful reaction, and it met our target perfectly for a 12-to-1 risk reward trade. Now, if your initial margin on your account that you're trading was $10,000, so you put $10,000 into your trading account to trade with, and you are only risking 1% of your account size, so 1% of that $10,000 is $100. So you were trading with $100 on this buy position. That would be $1,200 profit on that trade. That's how you start. Obviously, we'll be talking about lot sizing and calculating your trading positions and your risk reward ratios later in the trade management module, but that's just to start to get your head around trading positions. And like, for example, even if you just targeted this high, it still would have been an almost a 5-to-1 risk reward trade. Now, the time comparison here, that was only between, that was like almost 4 hours, that trade just there, for a 4-to-1, compared to this 12-to-1 risk reward trade, which was actually 4 days to reach the take profit. From the time I entered the position to the time it met my take profit, it was 4 days in length. Now, I don't really need to show you too many examples of a lower time frame entry because you've seen it in multiple videos before. Now, when I'm talking about a lower time frame and a higher time frame entry, that does not change. You don't factor in counter trend or continuation entries in that. You can have a higher time frame continuation entry, you can have a higher time frame counter trend trade entry, you can have a lower time counter trend trade entry, and you can have a lower time continuation entry. So there's lots of different entries that you can take using this strategy. Again, this is a perfect trade for someone that is busy. They don't have too much time during the day to be sitting at the charts. They work night shift. If you work in FIFO, whatever it is, especially if you're starting out as a new trader, It's simple. You can start to get your head around these trades before you start moving on to the lower time frame entries. So that is it for today's lesson. Please, again, backtest every lesson that we go through. You need to be backtesting, you need to be practicing. Nothing's going to come from you just listening to my voice. Yes, it's all good information to soak it all in, but you actually need to go and implement it in your own time. You need to practice. Listen, soak it in, repetition, repeat. So, but don't be afraid to ask questions.
You've made it to the end. That was brain-numbingly boring. I get it. My voice was horrendous. But you've made it to the end. I hope all of that makes sense, guys. If it doesn't make sense, make sure, like I said at the start of the video and every single video, ask questions in the Discord. I'm more than happy to provide extra videos for you guys if you need it. If you need a second video going through more examples of any of these topics throughout the program, I'll be more than happy to upload that for you guys, or I can show some screenshots and break it down in the Discord chat. Feel free to DM me. The door is always open. So that's it for today's video, guys. I hope you all enjoyed, and I'll see you on the next FX program video. Thanks, guys.